Support your favorite charity while potentially receiving income for life. CEF Advisors Pooled Income Fund allows donors to contribute appreciated securities, may provide a charitable deduction and lifetime income. Learn more at cefdata.com/PIF. Income and tax benefits are not guaranteed. Consult a financial professional.
Interest rate and credit environments, and with them, closed-end fund discounts are in flux. We're talking about where you can get paid for being patient with John Cole Scott, president of CEF Advisors. This is The Navigator. Welcome to The Navigator, which is all about all-weather active investing and plotting a course to financial success using closed-end funds. The Navigator is brought to you by the Active Investment Company Alliance, a unique industry organization representing the entire closed-end fund industry, from fund sponsors and creators and managers down to users and investors. In the search for excellence beyond indexing, the Navigator is pointing you in the right directions. Today, we're looking in the direction of municipal bond and taxable bond closed-end funds, and we're doing it with John Cole Scott. He's president of CEF Advisors, where they produce great data covering closed-end funds, interval funds, BDCs, and ETFs. And you can learn about the firm and dig into its data for yourself at cefadvisors.com. John's also the chairman of the Active Investment Company Alliance, which you can learn about at aicalliance.org. John Cole Scott, welcome back to The Navigator.
Always good to be here, Chuck.
Let's start with interest rates and what we see happening, because in the two spaces we're going to talk about today, which is national muni funds and taxable bond funds, well, they're reacting kind of in different directions when it comes to discounts as we watch the Fed try to figure out which way it's going to be moving next.
It is. So, I mean, even at the start of the year, we thought there was some chance for rates to go up. Even here in June, we're not certain what will happen the second half of the year, but I think it's definitely in the cards for a rate increase, as well as the possibility, whether it's late in 26 or sometime in 27, for rates to come down, generally due to potential economic challenges that require support from the Federal Reserve. But because, as you can appreciate, we build a multi-factor portfolio, we try to build on both sides of that barbell, with both muni funds tend to be above 10 duration and taxable bond funds tend to be sub 5 durations.
You've got rates looking like they're going to be staying higher for longer than people expected. Again, we've moved from an easing bias to a tightening bias. We've got spreads being tight. So what is that doing to discounts generally? Or is it not so much general because each category is kind of moving in its own direction?
Yeah, so it's interesting. And these are rough numbers from last Friday's close, but the average national muni bond fund is at about a 3.5 discount to net asset value currently, versus the 3-year average is 7 and mid change. And the taxable bond index is around a 7 and mid change currently, but a 3-year average of roughly 3.5. And so it's really the inverse of that. There's been narrowing with munis, and there's been not deep widening, but noticeable widening with taxable bond funds as the lay of the land for the universe of closed-end funds we track at CEF Advisors.
It can't just be about interest rates, though. I mean, the muni story has an interesting fallout right now because all of the data centers that need to be located somewhere, in some cases, if they're finding a home, they're doing it with municipal finance. And then on the taxable side, we've got all of this capital expenditure money that's going into AI things. You also have things like SpaceX and what they're doing, and that is creating at least new issuance, if not more demand for taxable bonds. So how are current events beyond interest rates factoring into the markets?
Absolutely. I mean, as you know, we're closed-end fund people at my firm. We're not stock people, but I hear a lot about NVIDIA. But to me, it's much more comfortable with all the data centers for AI. They're going to need all the infrastructure across this country to go in at a discounted muni bond fund, because then we have possibly more upside relative to the risk involved, and definitely inside the wheelhouse of a income-focused, more conservative investor than a stock chaser. And then think about the taxable bond side. I mean, this is kind of an interesting story because, when people hear this podcast, SpaceX should be trading publicly, and they're expected to absorb $20 billion in short-term financing into the taxable bond market. That's a significant amount of debt. And some of that could trickle into some of these closed-end funds that we track actively at CEF Data.
When it trickles in and you're tracking them, How does that impact things? I mean, as you're evaluating a portfolio, as you pointed out, you're not a stock guy. You're a closed-end fund guy. But I talk to a lot of long-term stock investors who are like, I don't want to touch anything SpaceX, at least for a while. How does it play into you analyzing the portfolios?
Yeah. So at a high level, I personally think that the multiple it's going to likely come at it is intense, almost 100 times earnings. And yet it's going to also be, because of its size and history, expected to be investment grade rated. And so I much rather get that levered access potentially to its bonds down the road than take on the whether Morningstar is right for its thinking about SpaceX, or whether Elon and his friends are right about the future of SpaceX's stock direction.
Let's move from those stocks back to the bond side of things. We are talking about the demand and what's happening with the demand picture. That spread of discounts that you were talking about, how much is it worth it for somebody who's looking now to say, okay, I'm stretching for a bigger discount? Like, average is not good enough. I want to be more towards the extreme.
Yeah, so we generally like to weight our portfolios at a weighted wider discount to a peer group average. Not every holding in a 30-40 position may meet that criteria. But one of the reasons why we're especially focused for muni bond funds is because they are relatively tight, not crazy tight. They go to premiums regularly, but with that risk of duration, if interest rates go up more than we plan, then durations of 10, 12, 13, 15 are going to be ugly like they were potentially back in 21, 22 when we actually had rates go up. So a deeper discount there protects you, because if that were to happen, the first thing to happen was discounts are widening, and we're picking funds today that already have wide discounts for a couple of different reasons.
You're picking funds, you're looking at these things. I know you didn't come here without a couple of funds for us to talk about. So let's start on the muni side. What's a muni name or two that pass your analysis, which I should point out to the audience is what you call the trifecta analysis? You can explain how it works, but what's a name or two and why are they passing the screens for you?
Absolutely. So really that's the thoughtfulness of balancing the discount risk, both comparable, relative, and absolute, with the dividend risk, which again can be challenging in some sectors, but also not just, whether it's a durable income or either the tax classification of some sectors of these funds. And then also the sector and manager analysis, from leverage to expenses to holdings, just where we have opinions of where we want to lean. So, for example, many previous conversations, I've said I'm overweight senior loan funds versus high yield right now for these reasons. And then we're picking funds that line up with that NAV analysis thesis. So the first one would be a Neuberger Berman NBH. And it's basically a little over a 10 discount. Its yields 6.3 and change. It's worth noting that, like many other muni bond funds, there's return of capital, but a lower amount than the peer group average, because that's a great way these funds have been defending activism, and at a wide discount that is like a democratized tender, less painful than if you got return of capital out of a premium. The duration is 13, which is right in the middle or just slightly above the peer group average. And we think it's a great way to get a well-regarded manager in this space with a pretty much clean access to a good story with a moderate duration, and we believe some discount upside as markets transpire, whether that's 6 months or longer, because we're patient for our income needs. The other one is MFM. It's actually an interesting story this week. It's part of an Aberdeen merger. They've done lots of mergers. You may remember they only IPO'd one closed-end fund. The rest have been mergers and acquisitions. And it's basically going, it's just had its distribution go up, as Aberdeen's been doing for many of their funds, from a 5 and low change to a 6%. Its discount still wider than 10, which is normal for merging funds. You tend to get wider discounts with the uncertainty of these mergers. And the leverage number is lower, 31, than it was 41 for NBH. And there's no reported return of capital currently, but I'll tell you, 6 months from now, we'll probably start seeing some based on the distributions. And the duration, while it's only 10 right now, based on the merged assets, we expect it to be closer to 15, 16 once the fundamental data gets updated in CEF data.
And I just have to ask, because it has basically no return of capital, since you talked about both of them. If you were picking between the two, if somebody said, okay, I just want to diversify with one or the other, is there a favorite there? Like, does the return of capital be part of why you might want to lean in one direction, even though the yield is a little lower?
So what I would say is the wider you are from net asset value, the more benign even unsustainable distributions fueled by return of capital are. With the caveat we say all the time on this show, Chuck, that you really need to not spend all those dollars. You should reinvest a portion of it. And so that's the main factor. The other interesting fundamental difference is that MBH is roughly 75% investment grade, and MFM and the expected combined merger is almost just over 50% unrated and non-investment grade, where you're really getting a different outcome because of different mix of investments. That we found these are both 10 discount solid funds, but also very different NAVs and a little bit different stories. And merge funds usually heal 6 to 12 months after the merger.
Well, let's move from the muni funds to the taxable bond side, because I know you got a couple of funds there too.
It is, and it's interesting. Now, most closed-end funds are high yielding, but then we actually, how do you define high yield? Is it absolutely high, or is it actually fueled by high yield bonds? And that's a great story here. So you have DLY, which yields about 10, discounts about 9, leverage is only 16%, duration's only 3.2. And what's interesting is mostly a mix of ABS and MBS, and then another sleeve of senior loans and a little bit of CLO exposure. So really a multi-sector bond fund. And one thing we liked about it, that's a wide discount for the universe, even wider than the 7.5 average, but its net asset value rank is 6 out of 24, which means it's a wide discount, but it's not been performing bad. So let's go to the other side of the coin and look at a global high yield fund, a true high yield fund, GHY, run by PGIM. It's almost the same 9 and change discount, a little bit higher yield, 10 and mid change, same leverage, 16%, duration's a touch higher at 4.9, and an asset value is actually 2 out of 24. But one of the interesting things in the top holdings, you see bonds from Argentina, Colombia, Egypt. I've said it before with other funds. These are not the type of credits that most of your podcast listeners probably have often in their portfolio, and a chance to get that at a strong discount, modest leverage, and we think a good global upside. One caveat about that leverage is that is low leverage for funds, which tells me with a steep yield curve, and they choose to, these funds can tactically add more leverage when it's benign for investors and possibly juice their yield even higher than the current portfolio.
And let's remind people that all of the funds we're talking about passed your trifecta analysis. And the trifecta discipline, well, basically, trifecta, duh, 3 things. But explain again what those 3 things are.
That we're comfortable with the discount range, which is both absolute, comparable to peer groups, and relative to itself. We have the dividend analysis, which is a blend of how sustainable it is. As we talked about, if it's a little bit too high, the discount must offset that. Also, to consider taxation for equity funds and areas there. And then net asset value analysis, which is the manager of the sector, that gets to expenses, that gets into leverage type and structure, things like that 60% possibly growing to 25 down the road in a more benign market. And we blend those together as the positions on our closed-end fund portfolio team, and we try to make sure that we have great overall data, but we like each position, recognizing there's no perfect closed-end fund. I've been looking for it my entire life, but we can usually massage to the right allocation for our outlook as CEF advisors.
Well, and what it leads to is kind of what we're seeing now. You've always said, when you see discounts on the index, that tells you where to look. Then you dig in, and that tells you what to buy.
Absolutely.
John, great stuff. Thanks as always for joining me on The Navigator.
Always good to be here.
The Navigator is a joint production of the Active Investment Company Alliance and Money Life with Chuck Jaffe. And yes, I'm Chuck Jaffe. You can check out my hour-long weekday podcast by going to moneylifeshow.com or by searching for it wherever you find your favorite podcasts. To search for more information on closed-end funds, interval funds, and business development companies, go to aicalliance.org. It's the website for the Active Investment Company Alliance. Thanks to my guest, John Cole Scott. He's president of CEF Advisors in Richmond, Virginia, and the chairman of the Active Investment Company Alliance. You've heard about his data? Well, you can dig into it for yourself and learn more about the firm at cefadvisors.com. And John's on X at John Cole Scott. The Navigator podcast is available every Friday. Make sure you don't miss an episode by following or subscribing on your favorite podcast app. And we'll be back again next week with more closed-end fund talk. Until then, happy investing, everybody.